sir and everyone, I'm CHANDRABANU, daughter of RAJAMANI, metric number 275482. Well, as my part, I'm going to explain more about money market instruments in Malaysia. For the first, I'm going to explain what is money market, example of money market, and why it is important. Well, as the name suggests, a money market instrument is an investment mechanism that allows banks, businesses, and governments to meet their large but short-term capital needs at a lower cost. They serve the dual purposes of allowing borrowers to meet their short-term requirements and providing easy liquidity to lenders. The second part is example of money market instruments. Banker's acceptance. Banker's acceptance is a document that promises future payment which is guaranteed by the commercial bank. It is used in money market funds and will specify the details of repayment like the date of repayment, amount to be paid, and the details of individual to which the repayment is due. Besides that, bankers' acceptance features maturity periods that range between 30 days up to the 180 days. The second example of money market instrument is Treasury bills. T-bills issued by the central government and known to be one of the safest money market instruments available. Besides they carry zero risk, the returns are also not attractive. They come with different maturity periods like 1 year, 6 months or 3 months, and are also circulated by primary and secondary market. The last example is repurchase agreement. Repo are also known as reverse repo or repo. They are loans of short durations which are agreed by buyers and sellers for the purpose of selling and repurchasing. However, this transaction can be carried out between RBI approved parties. Why is money market important? It is important because it provides funds, no need to borrow from bank, helps in financial mobility and in also monetary policies, promotes liquidity and safety, economy in use of cash and being equilibrium between demand and supply of funds. Well, we move to the second part, which is a funds management in the money market. There are two parts in this funds management in the money market. The first one is objective of money market. Objective of money market categorized into four. The first one is help the central banks in regulating liquidity in the economy. The second one is facilitates in streamline functioning of commercial banks. Third one is help in designing effective monetary policies. And the last one is not only help in the storage of short-term surplus funds but also help in lowering short-term deficits. The second one is features of money market instruments. Features of money market instruments categorized into three. First one, liquidity. Second one, safety. And the last one is discounted price. For liquidity, they are considered highly liquid as they are fixed income securities which carry short maturity period of a year or less. For safety, since the issuers of money market instruments have strong credit ratings, it automatically means that the money instrument issued by them will also be safe. For discounted price, one of the main features of money market instrument is that they are issued at discounted price on their face value. Alright, for the last part is money market. The Malaysian money market comprises into two markets, which are conventional and Islamic markets. There are certain similarities between these two markets, which are the first one is interbank market. Interbank market for Islamic is utilize Sharia compliant contracts such as wakalah, mudarabah, and murabaha. For conventional, the debt contract is used for placement of funds. The second one is issuance process. Issuance process for Islamic must be Sharia compliant and approved by both SACNB and MNSCN. For conventional, approved by regulatory authority only. The third one is type of structure. Type of structure for Islamic structure based on asset, equity, and debt. For conventional structure based on debt only. The fourth one is investors. Investors for Islamic are Islamic and conventional, but for conventional, investors are the conventional only. The last one is money market instruments. Money market instruments for Islamic are Mudharabah interbank investment, Wadiah acceptance, commodity murabaha, wakalah deposits, and investment account platform. For conventional is interbank placement, which is deposits. That's all from me. Thank you.
Thank you to our first presenter, Chandrabanu, anak perempuan Rajamani. A very good morning to my lecturer, Sir Shahril bin Shafi'i, and all my fellow colleagues. My name is Muhammad Khairul Anuar bin Abdullah. Now, I continue this presentation about how to read the money market rates. As we all know, the money markets refers to the trading in very short-term debt investments such as overnight reserve or commercial paper. At the wholesale level, it involves large volume trades between institutions and traders. At the retail level, it includes money markets mutual funds bought by individual investor and money markets accounts opened by banks customer. The money market is categorized by a high degree of safety, liquidity, and relatively low rates of return. The money markets and its instruments are usually traded over the counter and therefore cannot be done by standalone individual investors themselves. It has to be done through certified brokers or a money market mutual fund. In the wholesale market, commercial paper is a popular borrowing mechanism because interest rates are higher than for bank time deposit or treasury bills. A greater range of maturities is available from overnight to 270 days. However, the risk of default is significantly higher for commercial paper than for bank or government instruments. The main money market instruments are treasury bills, commercial paper, certificate of deposit, and call money. It is highly liquid as it has instruments that have a maturity below 1 year. The primary means of money market operations are open market operation through which the bank provides loan to the financial institution or purchases from or sells to financial institution assets such as Japanese government securities. Bank Negara Malaysia will hold the overnight policy rate at 1.75% at its final meeting of the year, according to all 18 economists surveyed by Bloomberg. That would mark an 8 rates meeting holding borrowing costs steady despite protected lockdowns and 2 revisions to the 2021 economic growth forecast. Interest rates goes down in Malaysia. Malaysia has lowered its interest rate by 0.25 percentage points from 2% to an annual rate of 1.75%. The key rates are a tool used by central banks, which is BNM, to implement monetary policy. A reduction in interest rates counters a weakening of prices or a possible deflation situation. It also revitalizes the economy and helps to increase exports. This change is the first to have taken place since May 5th. 2020, when the central bank lowered interest rates by 0.25% points to 2%. People can see the progression of interest in Malaysia and also for other countries from Bank Negara websites about all the economic information in Malaysia, other countries' economies. Next, interest is the price paid for use of money. And interest rate is the ratio of amount of interest to the amount of money. Interest rates are generally expressed in terms of percent per annum. When interest payment takes place at the beginning of the transaction, the interest is paid on the discount basis, which is discount rate. When the interest payment takes place at the end of the transaction, normally together with the principal amount, the loan and interest are said to be paid a balance payment basis, which is coupon rate. The amount of interest paid is subject to an agreed interest rate first, second, a defined amount of the fund, the principal, which is the principal. Third, a specified period of the deposit, tenure or maturity. Fourth, an end date or maturity date on which the taker pays back the principal and any interest due to the giver. We can set aside funds in a deposit account with a bank or credit union known as a money market account. Some banks also call this money market deposit account, although some may compare this to a conventional savings account. A money market deposit account does have some key differences. Some accounts may allow investors to write check or do transaction with debit card, but because these accounts are meant to hold savings, the number of transactions is limited by federal guidelines to 6 per month. Additional debits usually incur a fee. Money market accounts may also come with minimum balance requirements. If this balance is not met, then the account holder is subject to a maintenance charge. Similar to a money market account, a money market mutual fund provides a relatively low risk setting for cash equivalent liquid funds. Money market mutual funds are just like mutual funds in that investor buy and sell shares or units of a fund offered by an investment firm. Unlike money market accounts, these funds are not insured by the Perbadanan Insurance Deposit Malaysia (PIDM). Instead, they are subject to regulations set by the Securities Commission Malaysia (SC). Because the money market is dependent on highly liquid assets, these investments are fairly safe and come with low risk. That means they are also categorized by a fairly low interest rate compared to other investment. Because the underlying assets in money market investment are fairly low risk, the interest they pay tend to be low as well. That's all from my part. Next, I will pass to Muhammad SHAHRUL NAJMY bin REDZOAN to continue the presentation. Thank you.
Assalamualaikum warahmatullahi ta'ala wabarakatuh, and good morning to Sir Shahrul bin Shafi'i. Thank you to the previous presenter. It was a very good presentation by you. I am Muhammad Shahrul Najmi bin REDZOAN 269965, and I'm gonna be continuing about the ways to maximize returns from short-term excess funds. The first way is to build a plan to suit your needs. Under the first way, there are 3 types of plan, which are work with banker. This is meant like to establish a liquidity optimization strategy that works for you once you have looked at the timing and quantities of recurring payments and revenue stream. The second one is cash management approach. It might be incorporate short-term overnight capital markets investment choice such as deposit accounts or money market funds, which could provide higher yields. The third one is banker can assist you in creating a customized strategy. This is to incorporate both savings and investment accounts so that you may maximize your profits while still having access to cash when you need it. The second way to maximize return from short-term excess fund is by invest excess cash in a brokerage account. A brokerage account is a popular type of non-retirement investment account. This is because, with no income restriction, a taxable account provides the most option for investing more money. And not only that, assets on the brokerage account can be used for any purpose without early withdrawal penalties, which means there are no penalty for early withdrawal. A brokerage account also offers many benefits such as tax planning opportunities in retirement, early retirement, paying for colleges, and leaving an inheritance with tax benefits. The third way is look to your partner for long-term support. Relationship with your banker plays an important role. This is because your banker can help you to choose a short-term saving model. The function is to align with your cash flow fluctuation. They also help you to create a long-term strategy. Building a liquidity management strategy that yields consistent requires a deep understanding of a business goals. And the last one is finding a partner to build a strong liquidity strategy. It is to optimizing liquidity in a complex task that requires a right partner. It is hard to find the right partner who understands the big picture of your business cash requirement and objective. If we do meet the right person, they can help you to put and use your excess fund to its best. Working with a bank can help you leverage unused cash, maximize earning, and take more strategy approach. It takes your company to meet the short-term needs and long-term growth objective. That's all from me. Thank you.
Hi, my name is SYAZANA binti ABDULLAH and my metric number is 281907. Today, I would like to share about how to sources for short-term funding requirement. But first, we must to know what is a short-term funding requirement. Short-term finance can be defined as any financing that a borrower pays off over a shorter repayment period. More specifically, short-term finance refers to any loan that a business pays off in under a year. Here, the emphasis is on short-term financing such as trade credit, commercial paper, and other forms of instrument with a maturity structure of 1 year or less. First is we want to talk about trade credit has become one of the most common form of a short-term financing available to business today. For business establishments, it is the form most often used when a firm buys supplies or merchandise. The supply will generally grant a period of time for the firm to pay for the goods even after it has already received them. Trade credit can assume three different forms: open account, notes payable, and trade acceptance. The most common is the open account, whereby a customer receives shipment of the goods and an invoice which details the price, quantity, and descriptions of the goods, along with a specific time for payment. Next is commercial paper. It's a form of financing which consists of short-term promissory notes which are unsecured and are sold in the money market. They are issued by large companies and primarily sold to other business firms, insurance company, pension funds, and bank. Because they are unsecured and are sold in the money market, they are restricted in use to the most credit-worthy of the large company. The commercial paper market includes a dealer distribution system and a system of direct placement. Most industrial firms, utilities, and medium-sized finance companies utilize the dealer market to place their commercial paper, and 5 major dealers comprise the market, which purchase the paper from firms and then sells it to investors. Denomination of commercial paper range from $25 to several rupees, and maturity runs from about 2 to 6 months with an average of 5 months. And last but not least, which is commercial bank loan. There are short-term bank financing plays a key role in the growth of a firm. Frequently, during the course of a year, there is a period in which cash inflows are not sufficient to meet cash outflow demands. Short-term bank financing is one important vehicle by which a firm can be carried through such periods. Types of unsecured bank loans usually take the form of a line of credit, a revolving credit agreement, or a transaction loan. Lastly is a secure loan, which is borrowing on an unsecured basis would always be the best method for a firm to use in obtaining bank financing. This provides then the benefits offered by long-term financing compared to short-term mostly relate to their difference in maturity. Long-term financing offers long maturity as a natural fixed rate over the course of the loan without the need for a swap. The key benefits of short-term financing is short-term financing usually aligns with a company's operational needs. It provides short-term maturity for 3 or 5 years than long-term financing, which makes it better suited for fluctuation in working capital and other ongoing operational expenses. Traditionally, short-term financing is provided by banks and has floating interest rate. Sometimes companies will artificially fix these floating rates with a financing derivative such as swap.
Assalamualaikum and hi, my name is ARINA HUSNA binti AMIR NORDIN. My matric number is 271585. I will continue this presentation with the last subtopic, which is cash flow management and the relationship among the financial market. Without wasting any time, let's get started. Okay, I will explain a little bit about the cash flow. Cash flow can be defined as a cycle. Based on the diagram, we can see that the business uses cash to acquire resources. The resources are put to work to produce like goods or services, and then the goods or services will be sold to the customer. From that, you will collect the deposit or funds, and so the cycle will repeat again and again. But what is crucially important is that you must actively manage and control this cash flow or cash inflow or cash outflow, because it is determined of the success of a business or otherwise. Cash flow can be divided into two components, which is cash outflow and cash inflow. Cash inflow is the movement of money into business, while cash outflow are the movement of money out from business. Here I include some examples of cash inflow and cash outflow. On my right side is a cash inflow, such as receive money from the sale, receive money from the customers outstanding, proceeds from a bank loan, investment by shareholders, and interest received on investment. On my left side is cash outflow, like paying salaries, paying other operating expenses, purchase fixed assets, paying principals and interest on loan, and lastly is paying tax. We already know a little bit about cash flow, right? So I will continue with the cash flow management, because cash flow and cash flow management is two different things. What is cash flow management? Cash flow management is the process of monitoring, analyzing, and optimizing the net amount of cash inflow minus cash outflow. By managing cash flow, it will help us to narrow or totally close the cash flow gap by examining the various items that impact companies' cash flow. It also helps us to predict how much money will be available to the business in the future, and also identify how much money that business needs to cover, such as debt or paying employees and the suppliers. In short, by doing cash flow management, indirectly will make sure business has enough money to keep running. So what is the difference between cash flow and cash flow management? Cash flow is the term used to describe changes in how much money in the business has from one point to another. Meanwhile, for cash flow management is keeping track on this flow and also analyzing any changes to it. This helps us spot trends, prepare for the future, and tackle any problems with the cash flow. Before delving into the subtopic in more depth way, let me explain about the financial markets. A financial market can be considered as any marketplace where buyers and sellers engage in the trade of assets such as equities, debt instruments like bonds, currencies, and derivatives. Financial markets are categorized by transparent pricing and basic regulations on trading, costs, and fees. Or we can say that the financial market provides the arena for the transfer of funds from surplus unit to deficit units. As you can see here, there are several types of financial market. The first one is money market. Money market is the market that trade debt securities with maturities of 1 year or less. Equity market is the market that involves in medium to long-term borrowing. Next is bond market. Bond market is a debt market that generally pay interest on instruments for a fixed period of time, which loan periods over 12 months up to 30 years. Derivative market are marketplace where derivative contracts are traded. A derivative is a contract that derives its value from its underlying assets or assets. For example, the values of an options on a stock depends on the price of the stock in the market. Lastly, forex market is the market where currencies are traded. The kind of money specifically traded takes the form of bank deposits or bank transfer of deposits denominated in foreign currency. Now we can focus on our subtopic, which is relationship between cash flow management with the financial market. As you can see here, when a deficit unit lacks of funds, it will issue financial instruments to the financial market. From there, the financial market will sell to the surplus units, and the surplus unit will buy the financial instruments from there. When the surplus unit buy the financial instruments, automatically the surplus unit will give or place the money or funds to the financial markets. So here, cash outflow happen because surplus unit buy the financial instruments. After that, the financial market will receive the money, and the money that they receive will lend to the deficit unit. So here, cash inflow happen where deficit unit receive the money from the financial market. In short, surplus unit will experience cash outflow after buying financial instruments, while deficit unit will experience cash outflow after issuing financial instruments in the money market. That's all from our group. Thank you.